Hello, my dear friends. This is Dr. Suresh Shenvi, and I'm again doing a podcast. I've been doing many podcasts, but all those were related to career. But today's podcast is very interesting because something which is very not, it's not taught to us very commonly. That is how we can invest, and we tend to realize it at a later part of life. Unfortunately, it is not a part of our curriculum. That is why I thought I will do this podcast, and I welcome Prabhakar Kudva, a very good friend of mine, actually. Very good. I know him because I have seen him during his education of engineering. The surprising fact is that now he is the director of Samvitti Capitals, which is involved in wealth creation management. And he would be an amazing person to guide us about investment. He has been recognized as the 40 under 40 investment manager from Association of International Wealth Management of India at a very young age. And of course, he has been handling investment of my friends too, who have personal experience with his expertise. And I'm sure that today's podcast will be very helpful to you. Of course, this is not a recommendation. I'm sure all this has to be taken as an educational purpose only. But I hope this podcast helps you to with the journey of investing in early days of your career. Hi, Prabhakar. I am excited to listen to you, and I have a very important question before the wealth management and investment. Is that you started learning in you did engineering, and I'm very keen to know that how you shifted from engineering to all these wealth management aspects.
Thank you so much, Suresh, for having me. So yeah, I think that is a question that I get a lot because generally it's although there are a lot of engineers out there in the markets, but changing the stream from being a software engineer to doing this full time, right? It is something that's not probably not very common. So I think the market bug kind of caught me very early. I think I started following markets from the time I was 16 years old. So I used to sit with my uncle, who was an avid market follower, whenever I used to come for summer vacations, and he used to kind of teach me about markets. So very soon I kind of realized that markets is a game that it really sits with the kind of person I am, right? Because there's certain things that I really love, right? So I love reading. I love thinking about what I read. I love being analytical. I like psychology. I like probability. So when you put all of these together, so market is the only place where you get to express all of these multifaceted elements, in one career, right? So I kind of realized that quite early that this is something that I will love doing. The second most important thing for me was, that market is a single player game. Right. So market, unlike many other jobs where you have to collaborate with many people to succeed, and there's a bit of elements of politics and so on and so forth. In the markets, it's very much between you and the market, right? It's basically everything is in black and white. The results are in black and white. So if you're good, you're good. You're bad, you're bad, right? So it's basically what I call a meritocracy. So you can I kind of like that about markets. That I can be my own. I can write my own destiny, so to speak, right? That was something that really motivated me to get into markets. So the interest in the market was there right from my 10th, 11th, 12th standard, right? But of course, I was fairly okay in studies. So in India, you either get into medicine or you become a CA or you become an engineer, right? So we got a fairly good rank in the entrance exams. And so I got into computer science, and I studied there. I don't regret it. I mean, I really that was a period, the 4 years in the engineering, because in engineering there is really nothing much to do, right? If you can ask your friends, they will tell you that we had a lot of free time, and I utilized that free time reading, learning about markets. Although things weren't as great back in early 2000, 2001 to 2003, because there was no YouTube, there was not much internet. Internet was there, but it wasn't as pervasive as it is today. The resources were not so much, but of course, I got to really start learning about it, and as the years grew by, I kept my interest momentum up. I started managing money for family and friends. I did really well, and soon opportunities started knocking, and in 2015 we set up Samvitti Capital along with my two other partners, one of whom is my cousin and the other one is a family friend. So we set up Samvitti Capital, and it's been 10 years now. It's been quite a journey. We've gone through multiple cycles in the markets, and we love getting up and doing what we love every day. That's where we are.
Amazing, amazing. And I completely believe in whatever you said, because I think majority people say that, as you said, you can do things on your own. One very common thing which everybody speaks about the medical and dental stream is you can start your own business. Which I think on the engineering side, I don't know whether it is initially they work in an organization and then there is a thought that they have to start something. But in the medical or dental field, I believe they may have this opportunity, but I would also know that there are challenges, and that is why, and the major challenge is the finances, and that is why this podcast is so important. One very common question, because now I am 40, but I never realized what is the importance of investing. And although you say, we use this market terminology very often, but for our general audience, young audience, what would be, in a very simple way, what would an investment mean?
See, an investment is something where you are putting out some money now in the hope that that money will multiply over a number of years, right? In very simple words, that is what it is. So the question is, how intelligently can you do it? Which asset classes or where do you deploy that money? So those are the questions which depending upon the person's needs and risk profile have to be answered. But essentially, any investment is taking out some money now and putting into some instrument or some business or some asset class, whereby over X number of years, 3, 5, 10 years, you expect that that amount should multiply.
Yeah. So if you want to do that, I think basically, if you see, I think when we are young, our maybe we are investing 5, 10,000 rupees, and maybe if you have accumulated one lakh rupees, so it becomes 2 lakh rupees without you working. But it looks
Correct.
very insignificant unless we invest a very big amount. Let us assume we have invested 10 lakh rupees, and then you say that by investing 10 lakh rupees, it may become 20 lakh rupees, but it depends on how fast it can be done. So
Correct.
yeah, so if you want to suggest this to the doctors, what would be a best time to invest? Because sometimes some people have a lot of difficulties initially. They do not have knowledge. They will wait someone till the end. They get some information, and then they will start investing. Sometimes they invest wrong. What would be an ideal time? Should you invest as soon as you start your journey, or you have to wait for some time?
Yeah, I think there are two paths here, right? So one path is if you don't know anything, that is how you start. And then if you're interested in the subject, because I know many doctors who are quite active in the markets, just like us engineers, I think markets pulls the doctors also towards itself because of, different reasons, right? So let's assume the first case right now, whereby you don't know much about it, right? So if you don't know much about it, you have to take the help of professionals. And the best product in India, I think, is the mutual fund, right? The mutual funds, there are many mutual funds for different risk profiles, right? So if you want to be investing into a debt fund where there is almost no risk, or a liquid fund, or you could invest in a mix of equity and debt, what is called as a balanced fund, or you could go into a pure equity fund. Now, within that, there are segments, right? You could be a large cap equity fund or a mid and small cap equity fund, right? Or you could be a mix of all three, which is called as a flexi cap fund. So depending upon each person's risk profile, right? Or you could have a multi-asset fund which invests in equity, gold, debt, and REITs. So depending upon your needs and risk profile, a good advisor can guide you where you can park this money. And it's a completely hands-off approach, right? You can focus on your main profession while this money kind of works for you. And you said that generally people have a small amount, right? In equity markets, right, the small amount doesn't matter, right? Because what really matters is the time frame, right? See, if you're willing to think about this equity markets as something that you will probably need for your retirement or for some very far away wealth creation goals, let's say children's education or marriage or their marriage, so that is where equity comes into play. So if you start small and keep adding, right? I mean, and there are so many calculators and so many things available online, you can just go and check. But even small amounts like 5,000 rupees per month, 10,000 rupees per month, and if you continuously add money to it as an SIP, then over a period of time these amounts can become fairly substantial. Not only that, it will become much more substantial than the other alternative, which is people keeping the money in savings and FD, right? Because there is almost no growth, and whatever little growth is there, that is eaten away by inflation, right? Because if you're saving money for a car, and today a car is available for 5 lakh rupees, and you're planning to save 5 lakh rupees in your FD or your savings bank account, and you will take 5 years to accumulate that money, you will see that by the time the 5 years have passed, the car will cost 7.5 lakhs. At that time, you're just stuck with 5 lakhs. So the inflation is something that really eats your purchasing power. So everybody has to have at least some portion in equity, because equities is what gives you that multiplier, right? The median returns on equities have been between 12 to 15% versus 6 to 8% in a FD, right? It's essentially double that of your next best competitor. So if you compound this 14-15% over 10-20 years, the differences become huge. So that is how you have to think about it, in terms of mutual funds over the long term as an SIP, if you are a beginner with no knowledge. But once you build up knowledge, you can definitely venture into direct stock investing. That, if you get it right, can be even more rewarding, because you can really, I mean, you would have heard those stories of, if you had bought one share of Wipro in 1985, it would have become so many 100 crores. Yeah, I mean, it's a bit exaggerated, but I think what we have to take away from such stories is that the potential for making significant wealth is out there in direct stock investing, right? Because even if you get one or two stocks right, let's say you invest 1 lakh rupees, okay, in a stock that becomes 20, 30, 40 times, right? Your 1 lakh is turning into 20, 30, 40 lakhs. And it's not something that is impossible. Many people have done it, but the second path requires a bit of knowledge. It requires a bit of time. It requires you to learn about the markets, the cycles, right? So these are the two paths available. The first one is very easy, anybody can do it. The second one needs a bit of focus and energy and effort, on your part.
So that is where Samvitti, I think, comes, and where you invest
Yes.
this capital investment. It invests in the stocks. When you say equity, you are meaning stock, because I'm sure many
Yes.
of our audience may not know it. So when you say
Yes.
equity, you are basically market linked assets, and where you are investing direct stocks. Uh, if
That is
I
correct.
if I may ask you, I'm sure it is never guaranteed in the future. How, like, if you go back 5 years down the lane, because it is almost 10 years since you are handling the wealth of others, how many years did it take in Samviti, like CAGR, people call it as, the returns, on an average, how much this Samviti capital was able to generate?
Well, the last 5 years have been exceptionally good. So I don't think that is a benchmark. So last 5 years, we have done something like 30-35% per year kind of returns. But again, like I said, that's not realistic. That is because we came off the COVID lows, and there was a lot of money printing that happened in the US. So I think a fair return would be, I would say, if you're doing it yourself, if you're taking the mutual fund route, then you can expect to make between 12 to 15% returns over the long term, right? And the calculation is very simple, right? The calculation is basically the how did I arrive at this 12 to 15%, right? Let's try to understand that. So as an engineer, I love equations. So the equation for this expected return is, the country is growing at about 7%, right? There is about 4 to 5% inflation, right? So what is called as a nominal GDP growth. So the real GDP growth is 7% plus 5% inflation. If you add that, gives you the nominal GDP growth, which is 12%. So the entire country, the prices of the goods and the businesses is growing at about 12% per year. Plus, on top of that, if you are a bit skilled, right, if you're investing in businesses which can grow faster than the country as a whole, then you can make another 3-4% extra. So that is how you get from that 12 to 15%. And if you are even better, and if you can really identify some smaller companies which can grow even faster, right? Because a company like Hindustan Lever, HDFC Bank, because of their size, they cannot grow at 30-40% per year, right? Because the base is so big. But smaller and mid-sized companies can grow faster. So if you're into the smaller and mid-sized version of things, then you can grow even at 18 to 20% CAGR. And these have been the 10-year, 15-year returns of mutual funds on an average. So if you go to websites like Value Research or any of these websites and look at the fund category returns, you will see that large caps have done anywhere between 12 to 15%. Mid caps have done between 15 to 18%, and small caps have done between 18 to 20%. So this is what has happened. The future can be better or worse, right? That's the thing about markets, right? Why are we getting paid extra than the FD? Because you are taking that volatility risk. You are taking that risk of uncertainty, right? Because of that uncertainty risk, you are being paid that extra return, right? But this is the band. I would say 12 to 20% is the band if you stay invested for at least 5 to 10 years.
Yeah, a very common thing which happens at our field is that let us assume we have some amount of money which are earning as a salary or maybe through work. Majority of youngsters will invest very little amount. Let us assume you have 50,000 rupees and people will only invest 2 to 4,000 rupees in the initial days. And then they realize that the two, maybe because last 5 years, the things were very good. What would be an advice for the youngsters? Should they take some risk and try to invest more, or there is a recommendation that okay, this much percent you can invest in these many things? Is there any advice from your experience since last 10 years?
See, there is this concept called as asset allocation, right? So the asset allocation is one of the foundational concepts of investing. So whether wherever you are as an investor, you have to figure out, like you said, right? If you have 100 rupees of freely available cash, you have to bucket it into two or three buckets. Like the first bucket is something that you may need for the next, let's say, 6 months to 1 year. The second bucket can be something that you need over 1 to 3 years. And the third bucket is the long term bucket, which you may not need to touch for 3 years and more. Right. So the first bucket typically has to go into areas like liquid funds or debt funds or FDs, because this is like emergency money, right? Because anytime in the next 6 months you might want to take it. This money should not go into equities because equity markets are volatile. Suddenly something Trump will say, something will happen, and the markets will correct. So this money has to be the safe bucket, right? The second bucket is the medium term bucket, which can go into what I explained earlier, right? A mix. There are funds which are a mix of debt and equity or balanced funds, or it could go into gold. So this is the bucket where there will not be a lot of volatility, but at the same time, that your for your 2 3 year goals, it is a fair place to hide. And whatever money you don't need beyond 3 4 years, right? That money has to go into equities, because any money that you don't need for 3 4 years or more, if you're keeping that money in an FD, or if you're keeping that money in something safe, then you are doing yourself injustice, because that money can afford to take the risk. See, we have to also understand what is the risk here. The risk is only the risk of volatility. It is not that your money becomes zero in the stock markets, right? Unless you are doing penny stocks or you're trading, you're doing futures and options. Those are the things to do where you can completely lose your money. But if you're investing in companies, right? If you're investing, let's say, in a mutual fund, you will essentially be investing in the top 100, 200 companies of the country. Now, these companies cannot go bankrupt, right? You have to understand that you are investing in the businesses at the end of the day, right? This money is not going into some casino or, it is, people think that stock market is speculation, but the underlying as an investor is a business. So you are investing your money into the top 100, 200, 300 companies of the country, right? These are established companies. So the risk here is not that it will become zero. The risk here is that the returns will fluctuate. Now, because depending upon what happens in the US, or depending upon what happens in Europe or Ukraine or India, there will be a fluctuation in returns. But if you can stay invested, till the markets recover and resolve, then you can make fairly good amount of returns. So the trick here is to figure out what that bucket three is, wherever the money that you don't need for 3 years plus, and allocate that to equity instead of doing it randomly.
But I think people are very scared, especially in the medical and dental side when you are young. When you say that, when you know these things which you don't know for next 3 years, that money. But to tell you frankly, in our side, we really don't know where the career will take. It might take some 5 7 years. Sometimes it may take 10 years. Sometimes you just pick up in 2 years, and you are in this situation where, in spite of, like, you don't know, there is no surety, and some many of us just sit on some of the capital thinking that it will be useful if something happens in 1 or 2 years. That is what is the confusion. But I have read some books, and one of the book did mention that in the long term, you can never predict how much is the return and all, but the one thing which matters is the principal amount. I think if you, the thing is how much time you are there in the market, or this investment journey, and you should concentrate on increasing the principal amount rather than concentrating on the returns. Is this really true? Because I feel if all of us, as if you are young and just concentrate on putting money and building money rather than thinking of the return, will it work?
It will absolutely work, right? As long as see, because end of the day, it is mathematics, right? So you are basically compounding your money at an X rate of return every year. So if the base of your capital is higher, the more money you will make, right? So if you invest 1 lakh versus if you invest 5 lakh, in 10, 15 years, that 1 lakh will become 10, but five will become 50 with the same rate of return. So obviously the base matters, right? The base matters, but most importantly, what you said, right? The ability to keep investing without bothering about the returns and allowing that money to compound, right? See, the problem comes when we are too fixated on how much did I make this year. So equities is not a 1 year game. Every year you cannot compare the return with an FD and say that this year I would have made more in FD. Like last year has been quite not so great, right? So returns have been almost flattish. So if this year somebody wakes up and says, oh, I was better in FD, that means he doesn't understand the rules of this game. So you cannot apply the rules of cricket to badminton, right? So it is similar. So the game here is the returns are lumpy. The returns come in one go. Sometimes you may have 2 3 years where you make nothing, and fourth year it will go up 60%. So net at the end of fourth year, you have made 15 16% per year returns. But if for somebody who doesn't understand this, and every year he is over analyzing, what is happening, why didn't I make money this year? Every year, if you have a need to make money, then that is the mistakes that people make. But if you keep adding money with a 5 10 year horizon, at least in the last 20 30 40 years, whether it is in India or whether it is in US, there has been no period where people have been disappointed, and I don't see any reason why it should be different in the future.
And what do you think a general mistake which everybody does in this journey? Because although you are a professional, but I'm sure that you might have seen doctors, other professions, thinking about investment. And then they might be approaching you, to get the guidance or the services available with your firm. What is a very common mistake which everybody does?
It's the same mistake that a lot of your patients might be doing, right? Basically, reading on Google with half knowledge and coming and experimenting, and so I think that your fraternity will really relate to, right? It's the same problem, because knowledge is what matters in any field, right? So so if you do not have knowledge, then you have to be able to, you have to be willing to accept that. And like I said, take a route where you're taking services of a professional. Like in your case, if somebody has some sort of a problem, then they come to a professional like you, they come to a doctor, right? So the problem is the entry barriers for trading and investing are very low. Like nobody can just become a doctor, by reading Google. They cannot open a clinic. But the problem with our field is that anybody can start investing. So, just open an account on Zerodha, you open an account on Grow, and you are good to go, right? So half knowledge is what really, hits people a lot. They just jump into the markets, and in a bull market, right? What we call as a bull market is a good market. When everything is going up, it's very easy to kind of make money, and think that you're very smart. So that is what happened, immediately post COVID. The 1 year after that was everybody made money just like that. Just, all you have to do is open an account and push money into any random stock, and you made money. But the knowledge that cannot last forever, or when that ends, whatever market has given, it will take all of that back from you. So those, that wisdom and that knowledge takes one cycle. It takes a few years for people to understand. So the biggest risk is, without knowledge, investing a large amount of money, or trading in the market, doing futures and options, or acting or buying or selling because somebody told, buy this stock, a tip, or what is called as a tip in markets, right? So based on some tip or some WhatsApp forward or something like that. So if so like, when you buy, as they say, like when you buy a fridge or a television or a car, we do days of research on the internet, right? But when you want to buy a stock, you will just buy because, of some WhatsApp forward. So essentially, to summarize, I would say that it is the knowledge gap. People have to understand that this is a serious activity. This needs effort. It's not that you can't do it, but you have to be able to put in that time and effort when you are ready to put substantial sums to work. But if you don't have that time, then you should take the mutual fund route, or you should look at some professionals.
So you have this service called as the PMS service.
Yes.
What exactly? How is it different than the mutual fund?
See, a mutual fund is more of a mass market product, whereby you can invest any amount, right, from 500 rupees to maybe 5 crores, 50 crores, 100, any amount you can invest. And it is a product that is created to cater to everybody. What is called as the retail investors. Now, but there are a category of investors in the market who can afford to take slightly more risk in pursuit of slightly higher returns, right? So in PMS, so we are one of the portfolio managers registered with SEBI, who's the regulator. So there are many portfolio managers like us. So what we essentially do is we try to build a portfolio of stocks for you, which is specifically we are building for you, whereby the risk profile will be slightly higher than mutual funds, and so will be the return profile, right? So if the markets fall, then we may fall more than mutual funds, and if the markets rise, we have to rise more than the mutual funds. But net over a cycle, our endeavor is to do better than an average mutual fund, right? So a lot of people allocate money to portfolio managers like us in a bid to make a higher return than mutual fund. And typically, these are sophisticated investors, who already have a mutual fund portfolio, but they have excess money which can afford to take, slightly more risk. So what you can categorize as a bucket four. So we spoke about the three buckets. Now you think about a bucket four, which can take some more additional risk. And those kind of accounts generally come with us. And that is why the minimum that the regulator has kept here is 50 lakhs. So we cannot accept anything that is below 50 lakhs in PMS. So, and this is done by the regulator so that only, so regulator's logic is the person who has 50 lakhs has, a good amount of knowledge about the markets, or he is fairly sophisticated as an investor. So that is what we do as a PMS. We manage money for HNIs and corporates who can afford to take slightly more risk in pursuit of slightly more bigger returns.
But you also launched a service where people can start with 5 lakh rupees.
Yes.
It's called as an advisory. Um,
Yes.
and how is it different? Is it better for the initial investors?
So advisory, I think, will sit somewhere between mutual funds and PMSs. So advisory, say in PMS, I have a portfolio which can be primarily small and mid caps. So there is more risk there. So in advisory, I have a portfolio of larger companies, right? You can call them large caps or large mid caps. So the risk level is significantly lower than PMS. And the thing with advisory is that we provide you an advice. The advice goes into you on the app, and then you have to execute it. So the final execution is up to you, right? So that is how the regulator has structured the whole advisory thing. So we have an advisory license also from SEBI, which we launched recently. The reason why we did that is 50 lakhs becomes a bit of a barrier for everybody. So that we had a lot of people, family, friends, and existing investors who said, "Do you have a product for something smaller?" Right. So that is when we launched this advisory with a minimum of 5 lakhs. But here, PMS is completely hands off. We manage everything for you. Here, we send you recommendations once in a while, and you have to execute it through our app.
So it is for two things here. One, you are doing the execution, and second thing is the risk profile, maybe for
Yes.
someone. So that is there. There is also something what is trading which people do, and does it really work, or do you advise people to think long term and consider investing? Because I feel that a lot of doctors do this, dentists do this. What's your personal opinion?
See, there are two ways to make money in the market, right? One is the easy way and one is the hard way. The easy way is investing, the hard way is trading, right? Now, but people for whatever reason, want to become traders. They want to take the hard way because it's there is an element of thrill there. There's an element of quick money. There's an element of speculation. There's an element of gambling there. So there are a lot of these futures and options, that products like that, whereby it's basically you are betting on a lottery. So there is this expiry day trading that people do, whereby you predict that today the market will close above this X level, right? If it closes above that level, you will make 2x, 3x your money. If it doesn't close, then you make zero. So essentially, it is like pure lottery, right? So people find an element of thrill there. And I know a lot of people in the medical fraternity who are bitten by this bug of trading, right? And I think recently SEBI also has, brought out a lot of research on this, that more than 95% of the traders lose money, which is a fact, right? Because trading is a very difficult activity to do successfully consistently. So you can be a good trader when the market is good. When the market is bad, you will lose whatever you have made plus some more. So net for traders to put money into the market and not lose it is very rare over a period of time. So investing is much more simpler, right? Investing, you can if you just stick around for 3 to 5 years, the probability of you losing money is very low. There's a lot of research on this also, that if you invest for 3 months, the probability of losing is maybe 50-60%. If you invest for 1 year, the probability of losing is 20%. If you invest for 3 years, the probability of losing is 10%. If you invest for 5 years plus, then the probability of losing is less than 5%. But the same doesn't go for trading, right? In trading, no matter what what strategy you are using, essentially you are playing for the very short term. right? So this is an area where, because of the thrill, a lot of people get attracted to quick money, and they lose a lot of capital, and then they start hating markets, and then they never even participate on the investing side, right? So it's very unfortunate. And but trading is a legitimate way to make money, but it has to be done professionally. It's a full-time job, right? Investing can be a part-time job. You can do your medicine, you can do your practice, and still be a good investors. I know many doctors who are phenomenal investors, who have spent years learning about businesses and investing, right? But trading is something where you have to be in front of the screen for the entire duration when the market is open. You have to react quickly. Every day is a battle. Every day is, you have to be at the top of your game. You have to have superior risk management. You have to have superior technology. So people take it too lightly. They trade on the mobile. That is not how professional traders operate, right? So trading is something which people think is very easy, but as their own experience will teach them over a period of time, that it is something where you are destined to lose money over the medium to long term. So I would advise and focus, all investors, to focus only on the investing side and completely avoid the trading time. You're not missing out anything. If anything, you'll be saving a few thousand rupees.
Which are the books you would recommend for the medical and dental community to understand this topic, maybe in a very simpler way? Have you come across any such books?
I think one of the best books, whether it's a new person or somebody's experienced, is this book called One Up on Wall Street by Peter Lynch. Now, Peter Lynch was one of US's most successful fund managers who ran the Fidelity Magellan Fund for more than 20, 30 years. So this is a book written by a practitioner, and it is a book which focuses on how can a common man build a stock portfolio? How can a common man understand markets? So anybody who comes to me, this is the first book that I recommend, not Warren Buffett, not Charlie Munger. It is this book by Peter Lynch called One Up on Wall Street. It's written in a very simple language, and it covers end to end. Right from understanding the nature of the market to stock picking to stock analysis to what mistakes to avoid, how to construct a portfolio, everything, and that too by a practitioner. It is not written by somebody who's into theory, right? It's somebody who has done this for 30, 40 years, day in and day out. So that's one book I think anybody who's interested should definitely read.
Can people become financially, free, the financial freedom by investing? And I don't know whether it is right to ask you, what would be, because everybody talks about retirement today, what would be it's difficult to calculate. I understand from situation to situation, cities to city, profession. What would be an ideal goal for someone, a young person from, let us take from Belgium city? What should he aim for? What should be the goal and amount? If you can just, if I don't know whether it's the right question to ask.
No, I think yeah. So the number that they talk about is 50 times your annual expenses, right?
Okay.
So if your annual expenses, if your monthly expenses are 50 lakh, oh, sorry, 50,000 rupees, okay, then your annual is about 6 lakh rupees. So 50 times is about 3 crores, right? If your monthly expenses are 1 lakh rupees, then 6 crores. And the idea behind this number is it's a fairly conservative number which takes care of inflation, and it takes into account what is called as a 2% withdrawal rate. So if you have 50 times your expenses and you withdraw 2% every year, then you can fund your expenses for the year, plus allow the remaining capital to continue to grow. So 50x is a slightly conservative in the sense that that's a bit on the higher side, but anywhere between 30 to 50x your annual expenses is a fair number, to aim or to plan for.
So here I think people may get confused because 3 crore, maybe it's a big number. I don't know. For many of us, it's a very big number. When you say 3 crore, that means at what age you should achieve 3 crore. So when you say 3 crore, that means you may be investing, let us assume some 50 lakh or 70 lakh, and that should become 3 crores by some age, and then you retire. And then that is how, is it like this? Or you have to have a principal amount of 3 crore invested?
No, no, no. You have to get to 3 crores, right? You have to get to 3 crores by the time you are 50, 55. That is the idea, right? So when you retire, if you have this corpus, then you can sell 2% of the corpus every year and fund your expenses. So that is not the number you start with. That is your target. So you can start with any number and plan to get to that number of 3 crores or 4 crores, depending upon what your monthly expenses are.
So I think you have given a very nice sum of the figure where 3 crore we should aim for maybe a minimum retirement amount, and that is the end amount. So we have to keep that in mind and start investing. But let us assume sometimes people at the beginning do not have 5 lakh rupees to start with. Sometimes they are also not confident. They don't want to get in mutual fund because somebody wants to wait to invest in equity. What would be a better way to start with an equity?
Yeah, I think, like I said, the first step is knowledge, right? So you have to learn the basics about the markets. So I had, spoken about a book earlier, right? So I would say there's one more resource called as Varsity by Zerodha. So Zerodha has, created this online thing called Varsity, whereby they explain everything right from the basics. So there is a, text format also and video format also. So that is an additional resource that one can look at to understand how to get started. Having said that, so the first step is, gaining this knowledge. And once you have the basic knowledge in terms of how the markets operate and, the key, what to look for, how to analyze a stock. So as doctors, I think you have some inherent advantages, right? So um, certain sectors like, pharmaceuticals or biotech or medical devices or hospitals, so you will have a lot of inbuilt knowledge in these sectors because you are kind of exposed to them during your education or even during your practice, right? So that is an area which, you can build expertise in, and that is an area from where you can start, because it will give you that additional confidence that you need. Because if you're investing in a financial firm or a bank, at the back of your mind you'll always have this worry that, okay, I don't really understand this, so I'm just blindly putting money. But let us say it's a pharmaceutical company, or it is a hospital. So if you read their results or annual reports or conference calls, so these are the two three elements that you have to read to really do direct stock investing, right? Especially the annual report and the conference calls which managements do. So if you get your hands on those and you can read that, then you will be able to inherently understand whether this guy is making sense or not, because you're in that field. So that is a very good area for doctors to start, building their portfolio. Of course, it need not be only that. Over a period of time, you have to build knowledge in other sectors also. But you asked how best they can start. So I think these sectors like pharma, hospitals, and medical devices, a lot of good companies listed in these spaces. Hospitals have been a big winner in the last 4 5 years. Every hospital has become a multi-bagger actually post COVID. They have done phenomenally well. Even and these private hospitals that are listed are also playing on the premiumization theme, because as India is growing, right, people are willing to pay more for higher quality services. And hospitals have done a great job in terms of creating wealth for their investors. So that's a good place for the medical fraternity to start.
Should they be investing in, because we hear so much about growth of India, and there are mutual funds which invest in the other countries. Should they even take that bet, like, let us invest some part in India and some part in foreign country? Do you advise this thing for a beginner?
See, if you're taking the mutual fund route, then these things become simpler, right? So, like I said, once you do your bucket analysis, then whatever is in the long-term bucket, you can divide that between India and US. See, these are the only two markets which are worth investing, right? All the other markets either are too opaque, right? They are not transparent, or they are low growth. Or, so India and US are the two big markets. These are the two markets which have actually generated wealth over the last 20, 30 years. All other markets have not done much. So there are mutual funds which give you exposure to Nasdaq or to the S&P 500. So if you're investing, I would say if you're investing 70% in India, you can put 30% in the US, or 80% in India and 20% in US. So we have to have our country bias. We have to invest, where we can watch the growth, because India is the fastest growing economy right now. All the other countries are struggling. Indian growth rate also has slowed down from 8 9% to about 7% now, but we remain the fastest growing large economy and one of the most promising countries for the next decade, right? And this is something that even the global media, which hardly used to speak about it earlier, is talking about it in the last 2 3 years. So India in the next 10 years is going to be the space to be. There is a big opportunity for all the investors to make returns. I'm not talking about some crazy returns, because but good returns, right? 15 20%. If you can generate, if you can do that for 10 15 20 years compounded, the numbers can be very huge. So this is an opportunity which nobody should miss. They should at least invest something. I would say start small. If you're not comfortable putting 40% in equity, you start with 20% in equity. But I think 20% should be the bare minimum. I think 20% of your salary you should be able to do away for more than 3 years, right? And you start with that amount, invest through mutual funds. It's professionally managed. It's a very well structured product, right? Invest through mutual funds, do an SIP. Whenever you read negative news in the media or in the newspaper or on WhatsApp, at that point in time, you should put more money, right? Because that is when
It goes wrong, I believe.
that is where everybody goes wrong, right? They put money when there is too much euphoria, right? Which is what happened last year. So the easiest way to make money in the market, if you do nothing, the simplest trick to making money in the market is whenever there is bad news, just go and put some money in a mutual fund. 2 3 years down the line, you will not regret. I can assure you that at least 9 times out of 10 you will not regret. Even the 10th time, right? Even if you wait for 2 more years, it will still work out well for you. So anytime there is a war or panic or these kind of things, but of course, money, the most important point is that whatever you're investing, you should not need that money for 3 years. You cannot invest money that you need in 6 months into the equity markets. That is one big mistake people make. So if you have long-term money and there is panic, it is a potent combination. Just close your eyes and invest. I know people won't do it because the reason why it's such a easy way of making money is because nobody does it, right? So it's so difficult in that environment to really take that risk, right? That people don't do it. But people have to remember that when you're investing in a mutual fund, like I said, you're investing in the top 100, 200 companies of your country. So you're not investing in some random penny stock. So you have to take that bet whenever there is a panic, right? And you will be rewarded.
So this is one mistake which you said. People generally don't put money when there is a negative news. Similarly,
Yes.
I believe because majority of us may suddenly start investing in equity, but they are not aware about the risk. What can some mistakes people can do which they would regret later when they directly start investing in stock market?
Yeah, so like I said earlier, right? So one is trying to do have a trading mentality, like a quick money mentality. That I
Yes.
want to. Somebody has told me some stock that will become a multi-bagger. It will go up 5 times, and typically these are penny stocks, right? So people love buying stuff like Yes Bank, and so those kind of names, right? So that is absolutely a no-go because you don't understand that if it were so easy, then everybody would be doing it, right? So you don't really even if you don't have a lot of knowledge, that's okay. But if you can bring the right temperament, right, which is long-term thinking, investing into good products like mutual funds, then you will definitely make money, right? So one is avoid getting into these tip business, right? The short-term business, avoid doing futures and options trading, and do not invest the wrong kind of money in the market. When I say the wrong kind of money, any money that you need for the short term, for the next 2 to 3 years, some money whereby you will not be able to sleep if the value comes down, because it will come down. So you have to be willing to see negative returns. That is the price you are paying for making twice that of FD, right? If there was no cost, then you will not make, that's the nature of the markets. There are no free lunch, right? So what is the cost of higher returns? The cost of higher returns is your ability to see negative returns and, sit on it. So I think keep it simple. Like I said, bucket three, focus on bucket three, 3 year plus money, focus on good products like mutual funds, and stay for the long term. And the icing on the cake is invest during panics and corrections.
But some books, I don't know whether it's nice to ask. Some book also or some videos say that only invest in index funds in the long run. It generates similar return. Is it really true, or it depends on markets to market? Country. Do you have any opinion regarding this?
No, see, let's understand what are index funds, right? So index funds are nothing but, like I said, right? So the Nifty index fund is nothing but a collection of the top 50 stocks. So index fund is typically very low cost, which means that all that they do is they don't apply any brain. What they do is they just invest your money in the top 50 stocks in a certain weightage, which is defined by the exchange, right? So it's because these are the top 50 companies. As the country progresses and does well, these businesses also do well, and consequently their stock prices do well. So the difference between mutual funds and index funds are also mutual funds, by the way. So the difference between an active mutual fund and an index fund, right? An index fund is also called as a passive mutual fund because it is passive. There is no intelligence as such applied there, right? You're just investing in the top 50, top 100. So what mutual fund managers try to do is that they try to beat this index by trying to manipulate, right? Instead of buying those 50 companies, they may, buy only 45 better ones, leave out five, or they may change the weightages of these 50. So they try to do these tweaks based on their knowledge and try to generate more returns than the index. So there are many successful active managers also. But net what is seen is that when you average out all of the active managers, the index fund turns out to be the best performer, because some active fund managers will do better than index, some will do worse than index. When you take the average, they become worse than the index funds after cost. So index funds are good, but they are not like they are not safe or unsafe. They're not any different from an active mutual fund. It is just that they're slightly low cost, but you then make the market, what is called as the market rate of return. So index funds can also go negative. A lot of people give this notion that index funds don't have risk. If the markets fall, index funds will also fall. During the COVID, index funds also fell 25-30%. Right. So it is not that index funds are risk free. Index funds are just it is a quantitatively based created portfolio versus a humanly created portfolio. So you can pick between any one of these, a fixed portfolio of 50 stocks, or a portfolio where a fund manager will apply some intelligence and try to earn a slightly higher return. So there is not much difference, I would say. There will be small differences, which is not really that big a deal for somebody who's just beginning.
Okay, so I think pretty much you have answered everything. Of course,
Sure.
you are an expert in this field, so sometimes all of our viewers might have some questions, but it is a beginning for them. And as you said, we have to read books. The problem is in the medical and dental curriculum, there is no education about the finances. Does it have? Do you get that information in engineering, or it is because you are surrounded with people, or because you are in maths and all those surroundings, you tend to think in that way, or because of your uncle, you said.
Yeah. So it was for me, it was my own interest, right? It was there is in the curriculum there is nothing, and to be honest, there is nothing that in a proper way teaches you about markets. Also, people learn about markets in a haphazard manner. Some friend will tell them some things. They will read some random books. So there is no structured way actually to think about markets, right? So this is an area that I want to work on, whereby I want to bring some structure to this for any DIY investors. That's why I've done a lot of podcasts, a lot of interviews on YouTube, and that is why whenever somebody reaches out to me, I look at it as an opportunity to get people to bring some structure into investing. Think about it, in terms of proper framework, right? Like I said, I try to explain the multiple buckets. So you have to really understand, how this thing works, and not just kind of buy and hope, right? Because then if you're in that mode, if you don't understand what you're doing, then you will bail out at the exactly the wrong time, right? When the markets fall, why do people remove money? It is because psychologically they feel there's something unknown. I don't want to take this risk. But if you really understand what it is that is happening, what are you exactly doing, what is this game about, then you will be immune to such psychological reactions, and you will actually end up making money.
But what is the best way to get educated? See, I also had no idea about investing and all. I have a very good teacher and a very good guide, colleague. His name is Dr. Vinayak, and he used to tell me all those things when I was, I think, 30 years. Never made any sense to me. And then, we used to do very little haphazardly, as you said. Then it started making sense over a period of time. So, at the conclusion, if you have one or two five, like you have spent 10, 15 years or maybe 20 years now, since you said you were so interested in market. If you can give maybe three golden rules for some youngsters in medical and dental fraternity to start this journey, which you have ultimately realized these are the some things we should do, maybe you can just tell it, and that is the end of this podcast.
Sure. So I think I would say number one is focus on your main profession, right? Try to earn the money there, because that is where you have a head start, right? That is where you can excel. That is where you can do well. And the first step is really to build the capital, right? So you to build the capital, that capital can come only from your profession, right? So a lot of people make this mistake of trying to make money off the market, try to do something part time. So they lose the big picture, right? Because you are neither here nor there. You are neglecting your profession, and also you're not full time into markets, right? So my first advice is focus on where you have a head start, where you have the knowledge, excel in your field. Try to become the top 10%, top 1% in your field, because that is when you can earn that substantial money, which can act as a base, right? And once you've got that, or once you're on the path to that, you don't have to get there. You don't invest in the market after you make substantial money, but once you are focusing on your profession, you'll automatically start doing well there. You'll start earning better. So whatever surplus you have, number two, have an asset allocation. Like I said, right? The buckets, right? Short term, medium term, long term. have a proper asset allocation and think, I mean, give it some time, maybe once a quarter, sit down, if not more, or at least once a year, sit down and figure out what are my investments, how is it divided, make a small Excel sheet and figure out what are the three buckets, where has my money been invested, what returns have I earned over the last 3 years in each of these asset classes, right? And have that kind of a way to calculate or a way to track where your money is, and finally have a big vision and a long term horizon, right? Have a vision, because just if you do the math, right, like I said, that if you start with, let's say, 5 lakhs today, right, in about 20 30 years, that 5 lakhs can become 5 crores, right? Just by compounding at about 16 17%. You can do the math, right? So it looks like I have a small amount, and but if you give it a long enough time horizon, and if you have that vision that I want to get to 5 crores, right, then you have that Excel sheet to track it on a periodic basis, so you'll be motivated to get to that goal. And so that is how you do it. So I think, so three things: focus, number one, on your profession, earn the money there, have an asset allocation to ensure that you are investing the right kind of money in the right asset class, and number three is have a big vision and a long term time horizon. So that is how I would summarize.
Amazing. I'm sure that if viewers want to know about Samvitti Capital, they can always visit their website. It's SEBI registered. I think that is the regulatory body, and it's very
Yes.
professional. Maybe that could be helpful. But as Prabhakar said, that you just have to select your buckets and start investing. I want to thank Mr. Prabhakar for giving me your precious time. And hopefully, this will inspire many of the youngsters from medical and dental community to think and have a big vision, as you mentioned at the end. Thank you so much.
Thank you for having me.